Have you ever looked at your bank account, then looked at the price of a starter home in your zip code and felt a cold knot form in your stomach because the math just doesn't seem to work anymore? You were doing everything you were told to do, working hard, climbing the corporate ladder, maxing out your 401k, yet somehow the goalposts for financial freedom keep moving further away every single year. We need to have a very honest, perhaps uncomfortable conversation about why making six figures in America today feels like making $50,000 did 10 years ago. The uncomfortable truth is that we are living through a silent erosion of wealth, where saving money in the traditional sense is almost guaranteed to make you poorer over time. If you look at the last 5 years, asset prices, whether that's the S&P 500, residential real estate, or even speculative assets like Bitcoin, have appreciated at a rate that completely dwarfs the average American wage growth. While your salary might have bumped up 3 or 4%, the cost of buying into the American dream, specifically housing and equities, has skyrocketed by double digits. This creates a phenomenon where you can be technically middle class based on your income, yet functionally poor when it comes to purchasing actual assets. You are effectively running on a treadmill that is speeding up every time you try to catch your breath. Most people in their 30s react to this by either giving up and doom spending on luxury goods or by taking insane risks with leverage to try and catch up. Both of those strategies are disasters waiting to happen. So today, we are going to walk through a different approach, a strategy I call the financial fortress, which is about transitioning from a passive earner into a strategic portfolio architect. But before we get to the specific allocation model, you have to understand the mechanics of the machine you are operating within, specifically the single most misunderstood concept in investing, the bond market. I know. Hearing the word bonds usually makes people's eyes glaze over, but sticking with me for the next 2 minutes could literally save you from losing 40% of your portfolio in a bad year. You need to master the concept of the bond seesaw, because if you don't understand this, you are flying blind in a high-interest rate environment. Here is the rule carved in stone. Bond prices and interest rates move in opposite directions, just like a seesaw on a playground. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Let's imagine you buy a U.S. Treasury bond for $1,000 that pays a 3.5% coupon or interest rate. If the Federal Reserve suddenly hikes rates and new bonds are being issued at 4.0%, nobody wants to buy your old, crusty 3.5% bond for $1,000 anymore because they can get a better deal elsewhere. To sell that bond, you have to lower the price to maybe $980 or $970 to make the effective yield attractive to a buyer, meaning you have lost principal value. Conversely, if rates drop to 3.0%, your 3.5% bond becomes a rare, valuable asset, and people will pay you $1,020 or $1,030 for it. This mechanic explains why so many investors got absolutely slaughtered in 2022 and 2023. Many people thought, oh, the Fed might cut rates soon, so they piled into long-term bond ETFs like TLT, which holds treasuries with 20-plus years to maturity. But they were wrong about the direction of rates. Rates stayed higher for longer, and because long-term bonds are incredibly sensitive to rate changes, TLT crashed hard, dropping over 40% from its highs. That's the level of volatility usually reserved for tech stocks or crypto, not what you expect from the safe portion of your portfolio. This brings us to a critical lesson for building your financial fortress. You must respect duration risk. For a 30 or 40-year-old investor looking to preserve capital while earning a yield, betting on 20-year bonds is currently a dangerous game unless you have a crystal ball for the Federal Reserve policy. Instead, we want to look at the short end of the curve. Short-term U.S. Treasuries allow us to harness high yields without the terrifying volatility of the long bond. This is where ETFs like SGOV, 0 to 3-month Treasury Bond ETF, or BILL become your best friends. They act as cash proxies that pay you the current high market rate, but their price barely fluctuates because the bonds mature so quickly. Now that we understand the tools, let's construct the actual financial fortress model, which is designed to keep you liquid, hedged, and exposed to growth all at the same time. We are going to use a hypothetical budget of $10,000 to illustrate this, but you can scale the zeros to match your actual net worth. The first pillar of the fortress, taking up 50% of your allocation, that's $5,000 in our example, goes directly into short-term U.S. Treasury ETFs like SGOV or similar instruments.
I can hear you screaming, half my portfolio in boring bonds? Yes, and here is exactly why. This 50% is your bedrock. It generates a risk-free yield, currently around 5%, which acts as a steady income stream that you can reinvest or use to pay bills. More importantly, this capital is highly liquid dry powder, meaning if the stock market crashes 20% tomorrow, you have a massive war chest ready to deploy to buy high-quality assets at a discount. Most people are fully invested in stocks, so when the market crashes, they can only watch in horror. With this strategy, you actually get excited about crashes because you have the liquidity to capitalize on them. The second pillar, comprising 20% or $2,000, goes into gold, and I specifically mean a gold ETF like GLD or IAU or physical bullion if you have a safe place to store it. Gold often gets a bad rap from the Wall Street growth crowd because it doesn't pay dividends and it's basically a pet rock, but they are missing the point of why you own it. Gold is not an investment in the traditional sense. It is insurance against the stupidity of governments and the debasement of the US dollar. When geopolitical tensions flare up, or when inflation runs hotter than the government statistics admit, gold tends to hold its purchasing power while paper currency dissolves. Look at central banks around the world, from China to Poland. They've been buying gold at record paces since 2022. If the people who print the money are trading their paper for gold, shouldn't you take the hint and do the same with a portion of your wealth? The third pillar is where we get our upside. 20% of the portfolio, or $2,000, goes into high-conviction growth tech or AI-focused ETFs. We are living through a technological revolution that rivals the internet in the 90s, and you cannot afford to have zero exposure to the companies building the future. Whether you choose a broad approach like the QQQ, NASDAQ 100, or a semiconductor-focused fund like SMH, this bucket is designed to capture the explosive growth of the everything rally. We limit this to 20% so that if the tech bubble bursts, you don't get wiped out, but if it doubles or triples, that 20% allocation does the heavy lifting for your overall net worth. The final pillar is the remaining 10%, or $1,000, which is held in pure, unadulterated cash or a standard checking account. This is your psychological buffer. It's the money you need for immediate emergencies, car repairs, or just the peace of mind of seeing a specific number in your checking account. So the breakdown is 50% short-term treasuries for yield and stability, 20% gold for currency hedging, 20% growth tech for upside, and 10% cash for immediate operations. Now, I need to address a very common trap that catches savvy professionals off guard, the real interest rate trap. You might look at your high-yield savings account paying 4.5% and think you're winning, but let's run the real numbers. If inflation is officially 3.5%, and let's be honest, your personal inflation rate for groceries and insurance is probably double that, your real return is already razor thin. Then Uncle Sam steps in and taxes that interest income at your highest marginal tax rate, which could be 24%, 32%, or more. After taxes and inflation, your safe savings account is likely generating a negative real return. You are slowly bleeding purchasing power while feeling responsible. This is why the gold and tech allocations in the Fortress model are non-negotiable. You need assets that can reprice upwards with inflation, not just assets that pay a fixed yield. We also have to talk about the macro environment, specifically the elephant in the room, Federal Reserve liquidity. Since the pandemic, we saw the Fed's balance sheet explode from around $4 trillion to nearly $9 trillion at its peak. That injection of roughly $5 trillion, which is an amount of money the human brain can barely comprehend, is the primary fuel that sent housing, stocks, and crypto to the moon. But here's the danger. As the Fed tries to normalize or holds rates high, liquidity can dry up very quickly in certain sectors. If you're heavily leveraged, meaning you have massive margin loans, huge credit card debt, or variable rate mortgages on investment properties, you're standing on a trap door. The financial fortress is designed specifically for a high-rate environment because it eliminates the need for leverage. You are becoming your own bank, generating yield from the government and holding assets that don't require monthly servicing costs. A lot of financial advice for people in their 30s assumes a low-inflation, low-rate world that simply does not exist right now. Following outdated advice like put 60% in stocks and 40% in long-term bonds would have decimated your portfolio over the last 2 years because both stocks and bonds fell together.
You have to realize that the correlation between assets has changed. When inflation is the driver, stocks and bonds stop hedging each other and start moving in sync. That is why we introduced gold and short-term treasuries. They are the true diversifiers when the traditional 60-40 split fails. Let's dig a little deeper into the psychology of this 50% treasury allocation, because I know it feels conservative for a 35-year-old who wants to retire early. Think of it this way. The S&P 500 historically returns about 10% a year on average, but with massive volatility that can see you down 20% or 30% in a single year. Right now, you can get roughly 5% risk-free from short-term government paper. You are getting half of the historical equity return with effectively zero risk and zero volatility. In investment terms, that is an incredible risk-adjusted return, and it allows you to sleep at night while the rest of the market is panicking over every CPI print or jobs report. This stability gives you the emotional bandwidth to hold on to your 20% tech allocation when it inevitably swings wildly. Most investors sell their growth stocks at the bottom because they panic when their whole portfolio is red. Having 50% of your money rock solid allows you to have diamond hands with the growth portion. It is also crucial to mention how this strategy fits into tax-advantaged accounts like your 401k or IRA. If you have an IRA, you can easily replicate this model. You can buy SGOV, GLD, and QQQ inside a retirement account to shield yourself from the tax drag we talked about earlier. Inside a 401k, you might have fewer options, but you can usually approximate it. A money market fund for the treasury portion, a broad tech fund for growth, and maybe a commodities fund if offered. If your 401k doesn't offer these specific choices, you might treat your 401k as the growth pillar of your total wealth and use your brokerage account to hold the treasuries and gold to balance it out. You need to look at your net worth as one giant pie, not a bunch of separate buckets that don't talk to each other. Let's pivot for a second to the why behind the 20% allocation to gold, because I know many of you are thinking, why not Bitcoin? Look, I'm not anti-crypto. In fact, you could argue for swapping half the gold allocation for Bitcoin if you have a higher risk tolerance and understand the volatility. But gold has a 5,000-year track record of preserving wealth during empire collapses, currency resets, and wars. Bitcoin has been around for 15 years. The fortress strategy is about survival first and growth second. It's about making sure you're still in the game when the dust settles. If you want to allocate 5% or 10% to Bitcoin, take it out of the growth tech bucket or the gold bucket, but do not touch the 50% treasury bedrock. That is your lifeline. One of the biggest mistakes our generation makes is thinking we need to hit a home run on every investment to catch up to the boomers. We see people on social media flexing 1,000% gains on option trades or meme coins, and we feel like 5% yields are for losers. But the reality check is, the people posting those gains rarely post the subsequent losses that wipe them out. Wealth is not built by hitting a home run once. It's built by consistently hitting singles and doubles and never striking out completely. The financial fortress is a strategy for hitting singles and doubles while protecting the stadium from burning down. Let's talk about implementation. How do you actually start this if you're sitting on cash or a messy portfolio right now? You don't have to do it all at once. You can dollar cost average into this structure over the next 3 to 6 months. Start by building the treasury position.
Get your cash out of that low-interest bank account and into a brokerage account yielding 5-ish%. Then start layering in the gold and tech positions on red days. Days when the market is down and everyone is scared are your buying opportunities. Rebalancing is the final piece of the puzzle that makes this machine work. Let's say tech stocks go on a massive run and your 20% allocation swells to become 30% of your portfolio. The discipline requires you to sell that excess 10% profit. I know, it hurts to sell winners, and move it back into treasuries or gold to bring the percentages back in line. This forces you to do the thing everyone says but nobody does: buy low and sell high. By systematically skimming profits from your winners and adding to your underperformers, you're mechanically growing your wealth without letting emotions drive the bus. I want to circle back to the purchasing power gap we started with. The system is currently designed to punish savers and reward asset owners. That's a fundamental shift in the American economic contract. You can't change Federal Reserve policy, you can't change the tax code, and you can't control inflation.
But you can control how you position your sails in this storm. By adopting the role of a portfolio architect rather than a passive participant, you stop being a victim of inflation and start using asset inflation to your advantage. This 50-20-20-10 model isn't about getting rich quick, it's about not getting poor slowly. It is about ensuring that 10 years from now, when you look back, you haven't just worked for money, but your money has actually worked to preserve your time and freedom. The days of set it and forget it 60-40 investing might be over, but the era of strategic, macro-aware investing is just beginning. The question isn't whether the market will be volatile. We know it will be. The question is, have you built a fortress strong enough to withstand it? Or are you still living in a house of straw?